Welcome to this explainer. If you've ever stared at your savings, looked at the stock market hitting yet another record high, and thought to yourself, yeah, I'm just gonna wait for things to cool down a bit, well, you're absolutely not alone. There's this universal anxiety we literally all feel at some point. It's that impossible task of trying to perfectly time when to jump into the market. We're terrified, right? Terrified of buying at the absolute top right before a massive crash. But what if our instincts about market timing are completely backward? What if waiting for that perfect discount actually costs you way more than just blindly jumping in at the highest possible price? Today, we're diving into some incredibly fascinating research that might just completely change how you view investing. To really wrap our heads around this, let's look at two totally different investors. First up, we've got Wendy. Wendy is our cautious dip waiter. She has one strict rule: absolutely no investing at all-time highs. Instead, she just sits safely in cash, patiently waiting for a 10% pullback before she puts a single dime to work. On the flip side, we have bad timing Bridget. Bridget is, well, she might literally be the unluckiest investor on the planet. She doesn't wait for dips, she just invests whatever cash she has exactly when she has it. But because her luck is just that bad, every single time she invests, she manages to buy at the absolute peak of the market right before it drops. No dips for Bridget, just peak after peak. So looking at these two entirely different strategies, we gotta ask the big question: who actually wins over the long run? Now, intuitively, your brain is probably screaming that Wendy beats Bridget by a mile. I mean, waiting just feels safer, doesn't it? It feels incredibly disciplined. You're avoiding those crazy expensive markets. Meanwhile, Bridget is like the poster child for buying high and selling low. But here's the catch. Waiting for a dip, that's still a form of market timing. You're basically making a bet that prices will be lower tomorrow than they are today. Let's see what the actual historical data proves about that exact bet. Okay, prepare to have your intuition totally shattered. Researchers at the Archbridge Family Office dug into the S&P 500 returns all the way back to 1990. They looked at three specific approaches: waiting for a 10% pullback, investing immediately at all-time highs, and just investing on completely random days. And the data? It reveals that investing at all-time highs, yep, the Bridget approach, mathematically produced higher average returns than waiting for a dip. Actually, it even beat investing on random days. I know, it feels entirely backwards. Why on earth would buying at record highs beat patiently waiting for a correction? Well, the secret behind this wildly counterintuitive math is momentum. You see, all-time highs don't just happen in isolation. They actually tend to cluster together during strong bull markets. Think about it for a second. During periods of real economic expansion, when earnings are growing and investments are flowing, healthy markets don't just hit one single peak and then immediately collapse. Not at all. They often hit dozens of new highs, one right after the other. The market just keeps trending upward. So let's think about the fallout of that upward trend for our dip waiter, Wendy. She suffers from these hidden but absolutely devastating opportunity costs. While she's feeling super safe sitting in cash, waiting for a 10% crash that honestly might not come for years, the market is just moving higher and higher without her. Sometimes that dip she's waiting for never even comes. Or maybe it finally does happen, but it hits so much later that the new lower prices are actually way above where Wendy could have originally invested. Because she was sitting on the sidelines, she missed the ongoing gains. She completely missed the magic of compounding interest. She missed years of reinvested dividends. But most importantly, she missed time. This invisible cost of lost time is exactly what completely drags her total return down. And honestly, this brilliantly highlights Bridget's side of the equation. Look, yes, Bridget takes a massive hit when she invests right before a crash. A 40% drop? That is incredibly painful. But Bridget keeps investing year after year, through the crashes, through the recoveries, and right on into the new bull markets. Her early investments have literally decades to bounce back and grow. A terrifying market peak today often just looks like a tiny little valley 20 years from now. It's kind of like planting a tree. Does it really matter if you planted your tree on the sunniest day of the summer or the cloudiest day of the year? Not really, right? The only thing that actually matters is that you got the tree in the ground and gave it decades to grow. So if waiting is mathematically the worst option, why do all of us still desperately want to wait? Well, it all comes down to psychology. Our brains are hardwired with this little glitch called loss aversion. Basically, it means we feel the pain of losing money far, far more intensely than we feel the pleasure of gaining that exact same amount. So when you log in and see the stock market at a record all-time high, your brain is literally screaming danger. It absolutely hates that vulnerability. It is perfectly natural to feel like the market is just too high. But as we're seeing, acting on that fear can be absolutely catastrophic for your wealth.
And I really want to highlight just how catastrophic acting on that fear can actually be. Looking at decades of S&P 500 data, Hartford Funds ran the numbers on what happens if you try to time the market and accidentally end up missing out on the market's absolute best performing days. Check this out. If you miss just the 10 best days in the market over a 20-year period, your total returns are cut by more than half, down 50%. Let that sink in. Just 10 days missed out of 20 entire years.
It gets worse. If you escalate that just a tiny bit, missing the 20 best days reduces your total returns by over 70%. Think about the gravity of that statistic for a second. You could literally do everything else perfectly right for 2 whole decades, but because you were sitting in cash, just waiting for a slightly safer entry point on a couple of key weeks, you surrender nearly 3/4 of your potential wealth. It's wild. And here's the absolute cruelest irony of all, and exactly why timing the market is basically impossible. Those historically best market days, they don't happen when everything is calm and sunny and predictable. The data actually shows they happen during highly volatile periods. Usually they hit right after major crashes, precisely when investor fear is at its absolute peak. This means that folks who get scared, pull their money out, and decide to just wait for some clarity, well, they almost always miss the explosive recovery days that generate the vast majority of long-term returns. So what's the fix? This is exactly why finding an emotion-free solution is so unbelievably powerful. Enter dollar cost averaging. This just means regularly investing a fixed amount of money, totally regardless of whether the market is at an all-time high or plunging in the middle of a massive crash. It completely removes your brain's loss aversion from the equation. You don't have to wake up and guess if you're being Wendy or Bridget today. You just mechanically, consistently buy the market. The 2024 plot twist: modern concentration risk. Now, before you go dumping every single dollar into an S&P 500 index fund, we really have to consider a major modern caveat here. You see, all that historical research on all-time highs is primarily based on the US market. But today, that market faces some very unique structural risks. According to data from T. Rowe Price, we really need to contrast the vast diversification of the broader global market against the US market. The MSCI All Country World Index contains over 25,500 different stocks. The S&P 500, well, just like the name says, is roughly 500 companies. So when you buy the US market right now, you're actually making a much narrower bet than you might realize.
And get this, it actually gets even narrower. Based on fascinating research from Rockefeller Capital Management, technology stocks now eat up a massive 41% of the entire S&P 500 index. That means all other sectors combined make up the remaining 59%. We literally have not seen a level of concentration like this since the peak of the dot-com bubble. By buying the index today, you are heavily exposed to one specific sector. Guinness Global Investors pointed out another super interesting angle on this recently. If you take the traditional market cap weighted S&P 500 and compare it directly against an equal weighted version of those exact same 500 stocks, there is a massive gap in their recent performance. So what does that gap actually tell us? Well, it reveals that a tiny handful of mega cap tech names are entirely carrying the index right now. If those few massive companies were to stumble, the whole index falls heavily because it's practically tethered to their specific performance. So while the S&P 500 has historically delivered amazing returns, it's pretty clear that it is far less diversified today than it used to be. But honestly, whether you choose to invest purely in the US or you decide to diversify globally, the core lesson of all this data remains beautifully, elegantly simple. Consistency beats perfection. Always. The pursuit of perfect market timing is just a trap. Trying to dodge the peaks means you are inevitably going to miss the climbs. You absolutely do not need to be some sort of Wall Street financial genius to win at this. You just need to be consistently present in the market. So as we wrap up this explainer, I want to leave you with one final kind of provocative thought. We're always taught that putting our hard-earned money into the stock market, especially when prices are hitting record highs, is incredibly risky. But when you really step back and account for the hidden costs of missed gains, missed compounding, and the fact that you're slowly losing your purchasing power to inflation every single day, you really have to ask yourself, is the real risk actually in the market, or is the real danger sitting safely on the sidelines, just waiting for a perfect moment that, mathematically speaking, might never actually arrive? It completely flips how we think about holding on to cash, doesn't it? Thank you so much for joining me for this deep dive, and keep learning.